I was ready to launch. And then I realized, hold on, I'm in a super capital intensive business. I need capital.
This mentality towards having to raise capital to build the business, specifically in the early stages, is a new thing. Where was this 20 years ago? It's like all the millennia of entrepreneurs that we have that were able to bootstrap their business through resourcefulness or go friends, family, and fools, right? How it should be.
So we've unlocked over 2 billion rand to thousands of SMEs around South Africa.
If I had to survey all of your customers right now, if more than 40% of them said that they would be devastated if you stopped existing, then you've got product market fit.
Essentially, the rule is that if you are the sum of your annual growth in revenue, top line revenue, plus by your profit margin, should exceed 40. And the idea basically being, if you're reinvesting a lot in the business, then you should be seeing that in top line growth. And if you're not, you want to make sure that your margins are healthy and you're building a sustainable business.
You mentioned all working together towards the same goal. What is that goal? Hello and welcome back to the Founder Files. Today I'm talking to Daniel Goldberg, the founder and CEO of Bridgement. Now, as a scale-up that provides financing to other small businesses, Daniel himself also had to get his own financing in the beginning of his business because this is quite an expensive business to start, right? If you are selling money to other people. So obviously we get into the inherent nature of the story, but we get into this kind of conversation of really debt financing versus equity financing in terms of your business as a startup. And what are the different options? Now, obviously there's no right answer to this, but we get into a bit of his view around what he thinks about being a sustainable company. Obviously, I give my opinions and thoughts about this, but then we get into his journey around how it really has built out the company to be sustainable, to be scalable. We learn certain frameworks like the rule of 40 and talk about how he's able to build out this Exco and Manco structure with a team of only 40 people, with an amazing approach towards how they cascade goals and clarity throughout the business that allows him the freedom to be able to focus on the problems that he wants to. For example, building out a partnership and white labeling their technology for a bank in South Africa. So not only do they have their core business, but now they've opened up another business unit, and he's got the freedom to pursue this even with such a small and agile team. So obviously talk about this journey and how he goes about doing that in between. And obviously loads more insights about entrepreneurship, about financing, just loads of thinking in between, right? And so if this is the kind of content that you dig, that you are here for, then you want to make sure that you're following and subscribing to the Founder Files now if you're not already doing so, because we've done over 120 of these by now, right? And so if you want to get these amazing insights from other entrepreneurs like Dan, finding more about what it means to scale your business faster with less trial and error by learning from people that have been there before, going through it now, then this is the podcast for you. To make sure that you are liked, followed, subscribe, all those things. Of course, the best way to support the podcast and the best way to make me feel happy as the host. So thank you for being here. Thank you for listening to this episode. And let's hear from Dan from Bridgement. Welcome to the Founder Files, the podcast that's like eavesdropping on a conversation with a successful entrepreneur over a fireside chat. Join me, Cameron Coots, through this unique experience of unfiltered stories and insights from scaling founders around the globe as they share their ups, downs, and everything in between. Dan, welcome to the Founder Files. This has been 4 months and 2 days in the making since we had our first conversation around preparing for this podcast. Obviously, there was a couple things that you wanted to make sure happened in the business before we had this chat that still aren't quite finalized, but I'm happy that you're here, man. I'm happy that we're about to have this conversation. Welcome to the show.
Thanks, Cam. Yeah, really good to be here. And I have to apologize. I've definitely pushed this off for way too long, but super excited to be here today.
That's all good, man. And just for the sake of the audience, right, the thing that we've been waiting to happen, right, was a partnership that you're developing with a bank. But because it's still not yet publicized, we're not going to be sharing that bank's name and information, but Dan's still going to share the story about what's going on behind the scenes. But yeah, man, just how's life? How's the past couple of months been?
It's been good. A super busy start to the year. I was saying the other day, I think I've been on about 12 or 14 flights in the last 2 months, so it's been a busy one. I'm a bit sick of seeing the airport, but yeah, it's we've had a strong year so far. Lots of exciting stuff in the pipeline. And yeah, just excited to continue and close out our financial year strong, which is coming up now in the next month.
Awesome. Now, because the majority of the listeners are entrepreneurs themselves. If they haven't heard of you, then your marketing team probably needs to have a bit of a chat with them to see why not, whether it's been on golf courses or social media, digital marketing, whatever it is that your channels are. To be honest, I say that like I know confidently where you are, but I just noticed you significantly on the golf course. But yeah, man, for those that don't know,
We're on the golf course, we must be.
yeah, well, if
We're on the golf course, we must be everywhere.
exactly. I mean, where else is there to market at that point besides billboards? So, for the sake of the audience, those that don't know you or know Bridgement, just what is your business? What's your business model?
Cool. Yeah. So Bridgement is a tech-driven fintech company that provides fast and flexible business finance, and we fund SMEs across South Africa. We have various products. We do business loans, we do invoice finance, we do a line of credit or a revolving credit facility, and we offer businesses anywhere up to 5 million rand. What makes us special or different is the tech and the platform that we've built. So we've made it really easy for businesses to access funding and to share their financial data. We have integrations into accounting packages and bank accounts and things like that. And at a click of a button, a business can connect their Xero account or their Sage or QuickBooks. We get all their financial data and can very quickly grant them funding. So that enables us to offer the best and quickest experience for businesses looking for finance. And one of the things that we're the most proud about is the time that it takes to get funding into our clients' hands. Anywhere from as quick as 45 minutes. That's our record at the moment. We're sort of slowly chipping away at it. But our record at the moment is about 45 minutes. So that's like a brand new company we've never seen before lands on our website. 45 minutes later, funds are in their account. It's a pretty amazing experience, and one that we pride ourselves on quite a lot.
No, I'm sure, man. You made me immediately think about the airline industry and especially such a competitive environment. So I think about FlySafair and how do they compete as like the most on-time airline, right? And so I think in your space, even though there's not a lot of large competitors, there's still a lot of players, right? There's still a lot of people that are able to provide financing for small businesses. And so, as a value prop, it's still there, right? And so the point there is like why should someone choose you over others? And without sounding too harsh or critical, it's not my job here to do this. I'm not your potential investor, but the conversation around the tech, right, and being able to get the loan quite quickly, I read that's a real differentiator to the banks, right? Because the banks is a massive clunky process with all the paperwork and the time, and you're getting interviewed by this person who knows nothing about entrepreneurship and etc. Right? Versus like the speed towards getting it. What else really separates you from a couple of competitors in the market? There's two names that immediately spring to mind, but for respect to them, I'm just not going to mention them. Right. So like, how is it that you really are separated? Look, the 45 minutes story, I think, is definitely a clear and obvious one. But what else really matters to your markets that you're able to deliver, you think, better than any other player in the market besides speed?
That's good. It's a good question because ultimately, what we're selling is funding, and funding is very much commoditized. Money is money. It doesn't matter who you get it from. And so naturally, a lot of customers looking for finance will be quite price sensitive. So one of the things that we pride ourselves on is leveraging all of this alternative data and alternative algorithms or methods of performing credit decisioning to offer clients the best possible rates that they wouldn't necessarily be able to receive on a similar product elsewhere. So our number one value proposition is convenience, and we say to customers, you're a business owner, you're super busy, time is money. On average, it's going to take you 5 weeks and a lot of documentation and a lot of paperwork to get funding from a bank. You can come to us and get funding within a few business hours. As I mentioned, record 45 minutes. I think our average is about 5 business hours. It's still the same day. And that level of convenience, business owners love. When I say convenience, it's a combination of two things. It's speed, which spoken about already quite a few times, but it's also simplicity. it removes the headache, it removes the paperwork, and we enable that through some of that smart technology that we've created, and we've been recognized for it. About a year or 2 years ago, I think it was, Xero announced us as the app of the year. That's a huge recognition in the Xero ecosystem. Across all of the different apps, inventory, payroll, all the various accounting sort of apps that businesses might use, we were announced a winner by that. We've won several other awards, but that's quite a nice one too. That talks a bit to the innovation and the simplicity that we brought to this funding process. So I think it's a combination of that convenience made up of speed and simplicity, as well as offering clients fair and super transparent and flexible pricing that works for them.
Firstly, congratulations on all the awards. I think the one from Zero is pretty epic. And whilst you were explaining that, and you've clearly got that well oiled and down because you've probably been asked that question a bunch, and you need to give that response. But when you were busy talking, they reminded me of this GIF, and I'm going to share my screen now, just so I can show you what it is that I'm referring to whenever people talk about like value. Have you seen this GIF before?
You can't do everything.
Can't do everything. So for the people that aren't watching and are only listening, there's just this GIF where there's three buttons. There's good, cheap, and fast. And basically you can't be all three, right? And so there's the mouse going over and it's clicking good, then clicks cheap, and then clicks fast, and then cheap goes backwards. Right. So if you can only be good and fast, or you can be cheap and fast, you can't be good. But what I'm hearing from Dan is like, well, at Bridgement, we've somehow managed to tape the one button down because it is good, it is cheap, and it is fast.
We've really forced that button down. Yeah, well, I mean, we're doing our best to optimize, everything from the experience to the price and to the speed. So yeah, it's whether one's better than the other, I don't know, but yeah, it's I feel pretty proud about how we've managed to balance it across all three.
Okay, so nice. It's like where other people are trying to compete on one of them is like, we're going to take all three, but the first one we're going to max to 100.
Yeah, absolutely. I think we know that in the market, from an experience and speed point of view, we're miles ahead. And we know that that's like the most important to customers. People are willing to pay for experience, so we've tried to optimize for the best possible experience.
100%. So cool, man. I want to go almost big picture / left field. We can get back into the chronology of the story. But even offline, we were just talking about this conversation around people very much in the VC ecosystem. And I mean, you've got investors on board. You raised seed capital to begin with. But, as someone who provides debt financing, who gets debt financing themselves, you've had VC as well. I want to bring in this kind of conversation around just your view or from a like a financing perspective, dilutive capital perspective. It's like, I know there's no perfectly right answer here, but I think I'm excited just for this conversation where it can go in terms of your opinions around like what's your philosophy in building a business and how you finance that growth without obviously being too biased, because I mean you sell this.
Yeah, look, I think ultimately, I value building a sustainable business that has strong unit economics from the beginning, and I think that business founders and early stage employees of businesses are able to be a lot more resourceful than some people may think. And the need for external dilutive capital is often a lot less than a lot of founders might think. Um, I have sort of followed a philosophy in building our business that we wanted to raise as little dilutive capital, i.e., equity, as possible, and grow a business as big as possible, without all the dilution that would typically come from several rounds of venture capital raising. So we followed quite a different approach to many other startups in the venture capital space. We did a single capital raise, so a single dilutive equity raise back in 2018. And in a short space of time, about a year to 2 years after that, got the business to break even. We had strong economics in the business, and we did everything possible to get it to break even. And then since then have just focused on reinvesting everything in the business, growing it organically and sustainably, and ensuring that the margins are continuously optimized. And that's enabled us to build a really big business now, and a very sustainable business without all of the complexity and dilution that would have come with many rounds of venture capital. I think there are pros and cons to these approaches. There's no right or wrong. Some may argue that had we raised more venture capital earlier on, we would have been able to take advantage of certain opportunities and grown quicker, captured more market share, things like that. So there may have been some pros to raising more venture capital, but of course that would have come with a lot more voices in the room, a more complex board, a lot of dilution, and a whole host of other factors like liquidity preferences, and things like that, which make it quite difficult to continue scaling the business and ultimately work towards an eventual exit. It's been an interesting journey and quite a different one to many of my friends that have started businesses. And looking back, I'm quite happy that that is the approach that we took, raising a very small initial seed equity round and then growing organically since then, leveraging a lot of finance along the way, but at least avoiding the dilution that would have come with further equity capital coming into the business.
I mean, one thing that I think about quite a bit is that VC, specifically in South Africa, is quite a new phenomenon, right? I think the reality of investors coming on board into businesses has been around forever. But this mentality towards having to raise capital to build a business, specifically in the early stages, is a new thing, right? It's like where was this in the and 20 years ago? It's like all the millennia of entrepreneurs that we have that were able to bootstrap their business through resourcefulness or go friends, family, and fools, right? How it should be. It's like, where is it that you can get the money? And then obviously the best place you can get your money from is customers, right? So I think I'm just super curious about what's happening in that space. But that all being said, the way that you explained this earlier is you use the term sustainable business as something that's kind of crucially important to you. And then I'm definitely not putting words in your mouth here, but there seems to be this narrative of how that kind of can compete with dilutive capital raising and the VC world. Talk to me about that. Like, why do you think that the building a sustainable business and going down the VC track of pre-seed, angel pre-seed, seed, like pre-seed round, pre-series A, Series B, Series C, da 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 da. Why do you think that might compete with being able to build a sustainable business?
Yeah, it's interesting. I think when you raise a lot of capital at an early stage in the business, and you're entirely focused on growth, and it's all about growth at all costs, um, you're not forced to ensure that the business that you're building and the unit economics in your business actually work and they're healthy. And you're also not forced to actually optimize on those. And I think what happens over time is that you just completely focused on growth at all costs, growing that top line. And some of those inefficiencies get swept under the rug. And
And
you're
only grow over
building
time.
systems. Yeah, yeah, absolutely. So they only grow and things compound. And I think that all of a sudden you've got a really large business, which is possibly operating incredibly inefficiently. And you've never had to really, um, you know, be super resourceful and operate in a constrained environment. And I think that can create a lot of difficulties down the line, and will oftentimes result in you having to raise more and more and more venture capital to sort of keep plugging away and keep chasing that top line. And in the event of growth plateauing, that can come with a huge host of issues. Whether it's a down round, The founding team getting diluted completely out of the game, being forced into an acquisition where there's some very unfortunate liquidation preferences, which result in the founding team not ending up with much. It comes with a lot of risk to the founders of the business. And if the growth continues, that's amazing. And maybe you'll get to the point where you get acquired before any of that matters and before anyone realizes these things. But I've I've considered myself a risk averse person. Even though I was a founder and started a business, which is arguably one of the more risky things to do. I chose to do it in at least the lowest risk possible way, at least from my view.
Talking about you being risk averse, but yet you chose to be a founder. Let's talk about the founding story. Why did you start Bridgement? And how did you start it?
Sure. So I think it probably starts all the way back to university days. So I studied engineering, did a dual biomedical and electrical engineering degree, loved software, loved data, and loved entrepreneurship. Tried to start a startup while in university. That failed horribly, but learned a lot. And I then went into management consulting out of university. I felt like I needed to learn more about business and how businesses operate, and more about strategy. And I worked for one of the American consultancies, working in financial services and banking. And so, yeah, it was there where I consulted to corporates and banks here in South Africa and in Nigeria. And I think that was the first time I got exposed to some of the inefficiencies that go on behind the scene at a bank. I got to see how some really critical systems ran on Excel spreadsheets, which was really eye-opening. But most importantly, I got to see how small businesses were in this weird space between consumer banking and corporate banking, and were really overlooked and underserved. And there are a whole host of reasons why that's the case, which I won't go into now, unless we want to chat about it a bit later. But I got that sort of firsthand experience of how small businesses were underserved.
Sorry, let's get into that, because I think what the fundamental, we're all entrepreneurs, and we know the fact that it's like, besides resources, support, the right people to get on board, it's difficult. There's so many reasons why it's difficult. And I think specifically in a country like South Africa, where we don't have something like a startup act, we don't have convenient tax breaks, and we also have these oligopoly incumbents that are doing everything that they can from a compliance perspective to protect the status quo instead of getting disrupted. It's hard, right? So, what are some of these challenges that you noticed about them being underserved, specifically in the space? Because obviously this is where the birth of the idea and the gap came from, right?
So it's interesting. I mean, when you look at a bank, if you look at the consumer side of a bank, consumers, i.e., you and me, individuals, are quite homogenous. We all look quite similar in how we operate. We earn a salary once a month, or maybe we earn a weekly wage. We have similar expenses, a car, a home, etc. Yes, there's some variability within these things, but they look quite similar. And because of how similar they look, it becomes much easier to automate things and to build models to service a high volume of clients that may be low value sort of transactions. So you really can create products and systems that enable you as a bank to service those customers really well. On the other side of the spectrum, you have corporates. Corporates are super complicated. Each one is very different from one to the next. And there's a much lower volume of corporates, but the value of those sorts of transactions are way higher. And so for a bank to service those sorts of corporates, it makes a lot more sense. There's a lot more value in servicing them. And it's okay if you don't automate everything away. You can do things manually when there's so much value behind each transaction. And then you have small businesses, which are in the middle. And small businesses, unfortunately, are not homogenous. Every business looks completely different, depending on the industry they're in, depending on the maturity of the business, their how they manage working capital, their operating model. Every business looks so different and it's operating on different margins, etc. And there, in addition to that, is very little data that is well structured and readily available to quickly and easily service and offer like a finance offering to small businesses. And so it becomes really difficult to automate them. The problem is that the value of these sorts of transactions is not as big as the large corporates. And so if you're going to incur the same cost in servicing a small business versus the corporates, you're naturally going to focus on and prioritize those larger corporates and the higher value transactions that come with it. So that is part of the complexity in servicing SMEs, because of how different they are and the lower value type transactions that you're dealing with, making it quite difficult to automate, coupled with the lack of readily and easily accessible information and data to make decisions and to grant funding to those sorts of SMEs.
Well, and also to de-risk it for yourself. If I may jump ahead, this is where I start intuiting what's going on here, but I can imagine because of your experience, you saw the level of automation and standardization that was able to happen in the back end for consumers. And I imagine there's quite a bit of inspiration that you've taken towards your operations, your product, your technology from how that's done. But then the complexity comes in is that, every single business is different. So we need a process for verification, validation, like what's even the right amount of capital that you need, what's the rate that we're going to provide, and also what's the risk profile. So I think there's what I'm piecing together is like you've looked at this experience of both ends, and how do I take the lessons and framework from the top into the decision making criteria? How do I take the automation and standardization from the bottom and build something that's right fit for the middle?
Yeah, that's exactly it. I think I was fortunate in that the time around which I saw all of this and had this experience, there was a lot of new, a lot of changes happening in the market. And one of them was that a lot of systems and software providers were opening up APIs. For the non-technical listeners on the podcast, a lot of platforms were making it easier to share data in and out of their platforms. And so an example of that would be Xero. Xero came up with a basic accounting module, and then they created a marketplace of apps that could integrate via their API and push data or pull data in and out of their system and build solutions on top of their basic accounting module. I mean, Xero is an example, but there's also internationally, there's been open banking. South Africa's been a bit behind that. It's catching up now. And all of these things have made the sharing of data easier. And what that has enabled is better automation and building of systems around this SME financial data. So that I was quite fortunate that that was happening around the time that I left the consulting world.
Okay, so you've really got this recipe of knowledge on how to do this, and also just the right timing from a data opening perspective. Talk to me about the commitment and the launch, right? The nature of what your business does is it's not a cheap one to start. So as much as we can also talk about the whole beauty of bootstrapping a business, there's just some businesses where it's like, thanks guys, but that is actually not possible. I do need capital in order for this to start, especially when I sell money. I need money to sell money. So how talk to me about the actual kind of like launch and start of the business. And then when you got smacked in the face with reality.
So I think I did a lot of research into the SME market in South Africa. I looked at trends overseas, saw there was a big opportunity to create a better offering for businesses in need of finance. And the beachhead that I picked was invoice finance for Xero customers. So online invoice finance for Xero customers, super, super niche. But that was my sort of beachhead and where I wanted to start. And I built out an MVP. I funded it myself through savings from my first job, as well as some consulting on the side. And then I was ready to launch. And then I realized, hold on, I'm in a super capital intensive business. I need capital to actually extend, and I definitely, unfortunately, was not born, with a trust fund or anything like that. And I needed some serious balance sheets behind me to actually just go live, to even test the product, which is quite tricky. My preference would have been to test the product, start generating some revenue, get some traction before trying to raise any funding and dilute it. But unfortunately, when you're in the finance game, it's a bit more complicated than that because it's so capital intensive. So I think I knew I always was going to raise some sort of capital, venture capital. I just thought I didn't maybe realize how quickly or early on I would have to raise that venture capital. And I started approaching a couple of VCs. I had a really good sense of what tech startups, how they would typically raise, and the sort of the right quantum and the right percentage or dilution. And I very quickly realized that raising capital from a traditional VC just was not going to work. And the reason for that was because being a finance business, being a fintech business, I needed capital to uh, grow and run the business, the working capital, but I also needed the funding to extend to my sides. And trying to raise those two separately as a brand new business with no traction and no record is difficult, super difficult. And going to a lot of the traditional VCs, I realized they didn't necessarily understand the nature and the complexity of a finance business, and how to structure some of those capital structures, and all of that. So raising just typical VC would have been really difficult and complicated. I was super lucky to stumble upon the right investor, or type of investors. Um, and I found a investor who understood the venture capital space, and private equity space, but they also understood finance businesses, they understood banking, and all of that. And I was able to raise that initial and only equity raise with them, as well as some of that initial tranche of funding that we needed to actually extend to our customers. So it was quite a big awakening for me. Is not the path that I originally set out on. I thought I was going for a seed and then maybe a series A and B down the line, maybe not, but um, ended up taking capital from this investor who has been an amazing partner, and not just a provider of capital, but also a really valuable strategic partner, and ultimately enabled us to get where we are today, and also to avoid having to raise additional equity along the way.
Where I see a lot of early stage businesses getting into trouble is the founders kind of have this challenge between maintaining a sense of patience and also shiny shit syndrome at the same time, right? And so what I'm hearing from you, and again connecting the dots, is that without you having to raise additional capital, right, you had to just be super patient in terms of building out your own balance sheet in your business, right? It's the fact that it's like you had to get essentially the profits from what you're transacting to your client base in order to be able to lift the balance sheets enough for you to just stock more, but also then to be de-risked enough for any kind of debt financer to be able to finance you in order to grow as well. Talk to me about that kind of initial stage of patience. How much was required? Maybe not that much. What was that like?
So there was definitely a level of patience that we needed. I think having raised capital from this investor, and having the correct amount of runway or funding to extend to our customers gave us sufficient runway to prove out our model, and build up a track record which would enable us to then subsequently raise institutional funding. So we were able to get to that point probably about a year after we went
Oh, so
live,
you
a
did
year
two
to
races.
year
My
and a half
assumption was
after.
that you had one.
No, it was only one equity raise, but our first debt raise from an external third party was about a year and a half, or 2 years maybe from the time that
Right.
we went live. We are in the business of, if you think of us as a business that sells stock, our stock is funding, and how we get that stock is from institutional funders out there. And those institutions can be a corporate bank, it can be a insurer, it can be an asset manager, a credit fund. There's lots of different types, all private individuals. And we essentially get funding from them. We borrow from them non-dilutive capital, and we then extend that funding to our customers. And so initially, getting that funding was difficult. You need to have a track record. You need to give them comfort. They're going to look at all about your financial ratios, and the performance of the finance that you've extended so far. But we were able to get to that point around 1.5 to 2 years after going live. And then as we went along, we sort of just kept building on top of that, until the point now that we have a sort of whole host or panel of funders that we negotiate and obtain good rates from, and that's given us the firepower and the balance sheet to be a really big player and build a really big business in the market. And I consider myself quite fortunate in that the business has never had to worry about where that's going to come from. We've always been able to be much more focused, 95% focused on building out distribution, growing the business, and not having to worry about where that next sort of capital is going to come from.
So I mean, we'll get to distribution in a sec, but because I mean, the way you explain that is super interesting. Because if I had to think about a lot of other, like just any business with a tangible supply chain, right, is that if you're in agriculture selling fertilizer, right, there's only so many types of suppliers. There might be lots of competitors out there, but there's only like one type of business that you're buying from. But from you, it's everything from private individuals, family offices, insurance companies, institutional financiers, banks. There's so many different types, which means that like I imagine there's a lot of complexity here because there's similarity of what they're looking for is like, can I basically guarantee my my loan is going to be repaid? Like it's pretty much that simple. But they're going to have different needs, different requirements, different reason why they're coming to you. Never thought of an insurer as someone that you would get capital from. And where I'm going with this is like, what I want to understand is like, how do you operate this as a function in the business? Is it something that's kind of continuously operating and taking over? Is it part of someone's role? Is it part of your role? Or have you just been able to, over time, establish such significant strategic partnerships with certain players that you don't actually have to worry about this? Yeah. What does that function in your business look like?
It's definitely gotten a lot easier as we've gone along. I think as we've grown the business and we can show more and more track record, it's definitely gotten easier. So the conversations happen quicker. The decks, the PowerPoint decks that that we put together to show our performance and all of our results, I think become easier to compile, and the business has just started to talk for itself. It has there's obviously some really important relationships there, and we work very closely with them, and there's a lot of reporting requirements and all of that comes on a month-to-month or quarterly basis. But largely that's ticks on. Myself and my executive team manage those relationships, but it's not a huge sort of focus of on the business. There are a lot of investors out there who are looking for a good return. The credit funds are growing massively, and a lot of businesses are interested in investing in alternative debt. And so it can actually be quite an attractive investment. When you mentioned, being surprised to hear we would get funding from an insurer. Insurers have massive balance sheets. They need to put that balance sheet to work. They don't want all their funds just sitting around not earning a return. And of course, they want to diversify their investments. So it's investing in when I say investing in a business, lending funds to a business like ourselves is actually a nice investment, and they can get quite a decent return. So it's a complicated part of the business, but I think it's also one of the many ways we've gotten a lot of strategic value from our initial and only investor, because they have so much experience structuring these things, and they can be super complex. But for these guys, they've done it so much that was super helpful, and we knew exactly the sort of structures that we had to set up, and the terms and the covenants and everything that goes with those.
Yeah, because now actually thinking this out is I imagine that anyone that's in the B2B insurance space, like anyone that's an insurer, would make a lot of sense to be able to partner with you on both sides because, you being able to go into their treasury department and really like, how is it that we can leverage your balance sheets and get a return on this instead of just sitting on the capital? But also, I can imagine there's opportunities to have conversation on using their market as distribution for what it is that you provide because they're in the insurance space, you're in the financing space. And so has that happened? Has that opportunity availed itself? Are there any different like types of businesses where it's like you go to their treasury departments and then, they'll kind of carry on to you and then you'll chat to someone else in the business about a strategic partnership for distribution into their client base? I can imagine there's a certain profile that's quite synergistic.
Yeah, yeah, absolutely. I mean, we have had those distribution partnership conversations with a few insurers. Definitely happens. They're obviously two very different sides of the corporate of the insurer, and you're dealing with very different people, and so those conversations happen very much separately.
Yeah.
There's sort of no link between them just because of how big and complex
That's also
these
why you
sorts
can
of
get away with
businesses.
having both conversations at the same time.
No, absolutely, absolutely.
Well, has it happened? Has it succeeded? Or is that something that's, if it happens, then cool.
Yeah, so it's actually something that we're in the middle of exploring with a few insurers right now. It hasn't happened yet, potentially soon. It's an interesting one. I mean, it's we're talking to the same businesses. There's definitely room for a distribution type partnership. The question is which way it goes. Is it more us bringing business for them or them bringing business for us? Or is it a reciprocal type thing, which is a challenge with many partnerships. A lot of the time when we're speaking to guys, it's like, we want you to refer to us, but you want to refer, but we must refer to you. And like, where's the actual, like, who's going to benefit more? And how do you balance that? And is it reciprocal? Does reciprocal even work? Is there always going to be one person in the partnership that's going to benefit more? And so it's quite tricky getting those sorts of partnerships right.
Yeah, I think everyone's so keen to do a win-win deal, and towards like, okay, cool. Let's share your client base, we'll share ours, and then it's like, not that good, not that kind of win-win deal. But if you do get it right, I think it would be fantastic. But I mean, that being said, I think where it makes sense for those things to happen is usually in the conversation of a merger or acquisition. But I don't think you're quite there yet. Well, I mean, not at least in being the acquired, right? Maybe you're ready to acquire. We'll see. Is that in the pipeline? Actually, now that I bring it up.
Yeah, it's something we've considered. It was more in the context of a opportunity to expand overseas. And we, in terms of how we would launch in a new market, would we want to go and build something from scratch? Would we want to partner with someone? Would we want to acquire a small player? We had quite a strong preference for acquiring a small player, and we came across an opportunity there. So we have looked. We haven't pulled the trigger on anything like that yet, but always on the lookout for opportunities like that.
Okay. Exciting, man. Okay, so we spoke about the supply side of your business, right? So I'm very fascinated by the possibilities there. Let's talk about the distribution side, because again, you can have all the money in the world, but like if no one's actually taking your loans from you, then you're not really making any money. Besides billboards on golf courses, how else are you distributing to your market? What did you find that worked?
So we have done a lot of experimenting and testing over the last 7 years or so of operating, and we have intentionally never been too concentrated on any single channel, and that's largely just to avoid having any, being exposed to any major risk, and having any concentration that's too large on a particular channel. But we have built out a really strong distribution sort of engine across several channels. So a lot of digital. Naturally, we're a fintech online funder. So there's a lot of digital, both on the organic and paid side of things, and both on search and social. We've also, outside of the online side of things, we've built a really strong outbound direct sales team. And then lastly, we built a really good and strong partnership side to the business. And partnerships can be anything from smaller referral partners, brokers, SME advisors, things like that, to affiliates, to large corporates that have lots of SMEs as customers or suppliers, including banks. So we've sort of built out quite a nicely diversified sales and marketing engine in the business. We have the billboards and the events and all these things and PR for all the awareness, but we've built quite a strong and diversified distribution engine.
Awesome. And give me a sense of the scale that you're at now, right? And also your growth rate. How would you describe this without obviously giving away what's under the hood?
So the business has scaled massively. One of the key things that we look at is obviously the capital that we've unlocked or made available to small businesses. So we've unlocked over 2 billion rand to thousands of SMEs around South Africa. That's really cool and impactful sort of a stat that we like to track. Besides for how quick we are at getting the funding to businesses. The business at the moment is 40 plus team members, and there's also something called the rule of 40. Do you know about the rule of 40?
Is this a headcount rule? No. I know lots of rules, but not this one.
Essentially, the rule is that if you are the sum of your annual growth in revenue, top line revenue, plus by your profit margin should exceed 40.
Okay.
40%. And the idea basically being, if you're reinvesting a lot in the business, then you should be seeing that in top line growth. And if you're not, you want to make sure that your margins are healthy and you're building a sustainable business. Very rough rule of thumb, but it's a nice metric to follow, and something that we've exceeded quite nicely over the last few years in the business, ensuring that the business is growing and we're seeing a lot of that top line growth, but also the bottom line profit margins are healthy too.
Yeah, I really like that in terms of simplicity, because either what do we need to prioritize if it's less than 40? Why? And I also like the rule of 40 because the product market fit one, what that brings in is it's actually asking, if I had to survey all of your customers right now, if more than 40% of them said that they would be devastated if you stopped existing, then you've got product market fit. So add that rule of 40 to that with the 40% of your customer base, and then you're really off to the races.
Much easier when all the rules just have 40 in
I know.
them. Much easier to remember.
The 80-20 one can do that can take. We could just keep it to 40 for right now.
So it's a multiple of 40, so it's fine.
So yeah, as long as the math checks out, then we can keep with the rules.
Yeah, absolutely. Yeah, no, I think that's probably some of the things that we're the most proud about. So we built a big business, scalable, sustainable business with strong margins. And I think one of the things that I'm the most proud about is the culture that we've built in the company. We've got an awesome team, a really strong exec team with a fairly flat structure, but we've built an incredible culture where we have a team of 40 plus people who are all bought in and driving towards the same goal. And sometimes I worry that I love my team too much and I spend too much time with them. We do lots of activities and things outside of actual work hours and the business, but we've built a pretty cool culture, and it's something that I think is really difficult to get right. I'd like to say that I planned it all. I think there's some luck involved, but I'm pretty proud of the team that we've built here.
You mentioned all working together towards the same goal. What is that goal?
Ultimately, we are striving to grow and enable growth for as many businesses around South Africa. At the moment, that comes in the form of funding, but we have the intention to offer many other products and services that assist small businesses, in accelerating their growth.
Okay, so now I want to talk about your growth right now, right? Because we've mentioned so many already. I mean, even there's the potential topic of acquiring a business to accelerate geographic expansion. There's the exploring strategic partnerships with the insurers. You have got a partnership with a bank right now. I'm going to pretend I know nothing about that, and then you can share all the information. There's still the organic growth in terms of your core market, and there's still so much to be going out and getting, right? There's just and then now you talk about the different product ranges that you can add into this, right? So it seems like there's all these ideas. Yeah, how are you currently prioritizing and figuring out which are the best ones to pursue?
It's when looking at growth levers, it's really difficult to choose where you spend your energy. We have had so many opportunities across over the several years that we've been running, um, and there's the real risk that you get pulled in the completely wrong directions, or you just spread yourself too thin, and you end up being really average at everything. Uh, I think I've gotten pretty good at saying no to opportunities, and quite quickly evaluating whether an opportunity is worth pursuing or not. Um, every once in a while, we've gone on some tangents, but I've been pretty good at pulling up the handbrake when necessary. Um, yeah, I think the business has been growing organically really well, and the existing business, there's a lot of room for growth there, and we're going to continue focusing on that, and that is a huge priority. Um, outside of that, we've explored a lot of um, what some might refer to as like horizontal sort of growth, and that's through partnerships. Um, and that could enable real step changes in the growth of the business. And an example of that would be a white label partnership we have with one of the banks in South Africa, which is a super exciting growth opportunity. But it's also embedded finance offerings and things like that, where we can offer finance through other partners and platforms to have sort of one-to-many type relationships with lots of businesses around South Africa. Then there's also geographic expansion. We were looking quite seriously at that into a international expansion, and we decided to put a pause on that. We felt like we would rather be the absolute best locally, and continue building the business locally and have that running completely 100% optimized and smoothly before ever looking at an international partnership, but international expansion. But also, there's so much room for opportunity here, such as the bank partnership that I just mentioned, that we took a conscious decision to not spread ourselves too thin and really focus on the right opportunities at the right time. And I think down the line, we'll look to sort of expand vertically, looking at different products and services, getting closer to our clients, moving up or down the value chain. In our world, that could mean if we want to become a supplier to ourselves, essentially we would become a bank, become a deposit-taking institution. Now we don't have to raise funds from third parties. We can just have all the people who bank with us depositing their funds with us, and we can use that as our capital base. That is an opportunity. Not to say we'll do it, but those sorts of things are opportunities for down the line.
Sure. So you mentioned, yeah, I love this, and especially because of your background. I know you'll appreciate me indulging in the strategy theory right now. But the only other category you haven't mentioned there is diversification, right? It's because you mentioned organic growth, horizontal integration, vertical integration, geographic expansion, and then diversification. One thing I love just about these categories, and what's I think helpful to think about this, is why they exist. Right. Organic growth is simply the gold standard. It's like low effort, high reward. And it's simply growing your business with your own efforts and resources. And this is everything from investing into the team, investing into distribution, but it's building out the core business and core market. Now, there might be other products within that, but it's adding to the same market and adding the value and cementing your space there. Horizontal integration is exactly how you described it. Is in order to scale up faster than you can simply by yourself. And that's through partnerships, joint alliances, acquisitions, mergers, etc. Vertical integration is to take greater control over your value chain in order to improve either customer experience and value or profitability or both, right? So in your situation, becoming a bank, you increase your own profitability and take control over a big part of your value chain. And geographic expansion is obviously that's to scale into new markets, but that's basically starting a new business because it's totally competitive environments, especially like in your space, completely different like compliance and regulatory requirements. Like it's way more like everyone's like it's like well, I wouldn't say everyone, but it's very tempting because operationally it's the same thing, but it's really not in terms of like actually taking it to market. And then finally, diversification is de-risking the profitability of the core business model by starting a new business, either in a new market or an adjacent market or a completely different market altogether. Like unrelated, the best examples like Bidvest, right? So it's like on one side it's a bank, on the other side it's a cleaning company. So nothing to do with one another, right? But then also related would be, different parts of the industry and value chain kind of plugging into. Wanted to share a bit of the theory because you seem to be thinking about all of them at once.
Yeah, absolutely. And I think diversification is something that we're super excited about. Both diversifying in terms of expanding our offering within the finance space, but also expanding into non-financial offerings. What that may be, still early days, but we got a couple of potential products that are sort of in the works, early stage in the works, and we're very excited about diversifying that in the future. I think I mentioned before around when we spoke about the horizontal expansion, using the example of this bank partnership that we have. For us, that the way that partnership is structured is essentially we're providing our software, our technology, our intellectual property to a partner bank to offer a similar product, under their brand and their balance sheet. So it's an interesting change to how our business currently operates, where essentially it's a more of a capital light software side of our business, and providing a software service as opposed to a more capital heavy finance type product that the business currently looks like.
Yeah, I want to go into some more detail in terms of how you thought about doing that, because that in my mind, again, like just here telling you how you should do your growth strategies, but the point is that in like our label that is diversification, simply because it's a different business model. You're meeting a different need in the market, and the point is you're going a little bit further up the value chain, selling them the technology for them to be able to distribute themselves. And now it kind of changes where your core market of your business is SMEs. Now you'll be servicing anyone that, as a financial institution, that also wants to service SMEs. And so it's also this challenge of you're creating more competition for yourself. So what I want to know is tell me about the opportunity that kind of converted the thinking that it's like 100% we should do this.
Yeah, it's always a risk with those sorts of partnerships. So a white label partnership that you're potentially creating more competition. I think the view that we took was, you've got a bank that has made a strategic decision to move into this market. They will do it whether you are with them or without them, and we would rather partner up with them and be a part of that. In addition to that, the particular partner that we're working with has quite a remarkable story. They have a strong brand, and they service a market that's slightly different. There definitely is overlap, but slightly different to the market that we currently service. And so we're super excited to get more exposure to that market via this partnership. And we think that net it will be way more positive for us by partnering and enabling a new provider in the market.
Okay, so help me understand the business models here, right? Because actually I even asked the core business model of Bridgement to the core market, but I'm assuming that there is just a fee that goes on top of the financing that you're providing. I don't know if there's additional fees based on transactions that might happen in between, but it's really like we put a rate on top of this, and there's an interest rate for you to pay back that loan. And that rate and those terms are going to change depending on how large the loan is, what your risk profile is, and how quickly you repay it. Is that it's basically?
Yeah. So when I started the business, one of the key elements that I had in the business was that I wanted to make sure that we always kept it as simple as possible for the customer. And in this world, what that meant was offering the most transparent and simple pricing possible. the way we do it is when businesses can open up a facility with us completely for free. There's no like initiation fees or opening like facility fees or account fees or anything like that. So they can open up a facility completely for free, and they only incur a cost when they withdraw funds. The cost that they incur is a single, simple, fixed cost of finance. And the beauty of that is that it doesn't require you to go through your bank's 200-page PDF documents and hire some PhD to work out how your pricing works. You can take half a second, see what the finance cost is, and you know what you're in for. The other beauty is that it's completely fixed. So for the term of your finance with us, you know that you know exactly what your installments will be. There won't be any shock if there are changes in the prime lending rates or the repo rate or anything like that. The cost is fixed, your installments are fixed. You know what you're in for, and you can manage and plan cash flows accordingly. So we've really optimized for that simplicity and try to do things very differently to a traditional bank where could be paying an initiation fee, you'll be paying monthly account fees and facility fees, and then you obviously have your variable interest rate and all of that. And what people often don't realize, especially, and we often hear this if customers ever like compare us to pricing that they've been offered by the bank, they often don't realize how much those fees actually cost. I was going through the financials of one of the banks that came out about 2 or 3 weeks ago, and I was going through the financials, and it was quite staggering to see that their revenue, half of their total revenue came from fees and half came from interest. Now, customer by customer may be different. You might be spending more on interest and less on fees, but a lot of customers are going to be paying tons of fees, not so much interest. So it's quite, people often sort of underplay or don't consider those fees, and they just like hone in what's the interest rate, etc. And it's always important to consider all of the fees that you get charged. And unfortunately, a lot of the time, because the pricing from banks is so complex, you often don't even know what you're in for, and you only sort of find out after the fact. So we try to simplify things and keep our pricing way more transparent and simpler for businesses to understand and manage.
But I guess that also explains entirely the philosophy you've taken towards building your business, because in order for you to allow yourself to build a profitable, sustainable company with foregoing the opportunities for additional fees, means that you've had to be uber efficient as a business in order to be able to maintain that.
Yeah, absolutely. We've really managed to scale the business without having to hire a huge amount of people, without having to incur massive costs on the various systems that we use. And yeah, that's enabled us to grow sustainably with healthy margins, but with also offering fair and good pricing to the businesses that we're funding.
Awesome. Okay, and now the white labeling one. How does the business model for that work? Is that a fee-based structure based on transactions that they do on their platform? I mean, because they're going to be their own capital that they're deploying. How does that one work?
So we have different white label models. There are white label models where we call this a light label or a co-label, where we're still providing the funding, and it might not be a full white label. So the brand would say powered by Bridgement, so the customer would still know we exist, and it's ultimately they're contracting with us, and ultimately our capital that's going to them. So that's one sort of white label partnership. We then have a full white label, as an example, the one that we have with the bank, and that's where we're providing the software and the back office operations, but ultimately it's their brand, it's their balance sheet, and the customers don't know about us. There are lots of different ways of structuring these, and they tend to be quite customized and also quite confidential. But on the co-label and light label side of things, generally there is either some form of referral fee or commission type structure with whoever that partner is, because ultimately we're the ones putting up the capital, taking on the risk, using our RP, etc. So there's a big share in the value, but it's structured slightly different. And then with a full white label, there are lots of different ways of structuring, but usually you try and structure it as like a profit share or something like that, or joint venture, so that the incentives are aligned between all the parties.
Yeah, it makes sense. I both appreciate and don't appreciate the vague answer to my straightforward question, but I can understand why that was provided. Um, Sure, man. Okay, so I guess where are we at in the journey now, right? So I think you're busy, like this partnership that you mentioned that no one knows about, which means it's clearly not publicly live yet. What happens when it goes live? I mean, my assumption is that there's been a lot of efforts in making something like this happen. Corporates are difficult to deal with. When you're a 40-person team, I think there's a lot of effort that goes into that. There's still the core business that you're building. Yeah, I guess how are you managing the attention of you and your team on the core business versus this partnership, and how do you see that changing once it goes live?
It's yeah, it's been interesting, and it's definitely been a lot of work. Almost 2 years, 2 years of work. Just given how regulated and complex the banking space is, it's definitely drawn a huge amount of attention from myself and my executive team. We've tried to limit the impact within the business as much as possible, so that a very small handful of people are the minimal amount of people in the business have had to um, um, get involved in the partnership, and the majority of the businesses continue to run and operate as they have been. And we've also built out a strong sort of team of middle management that is also helping us run the business when our hands are super full with these sorts of new strategic partnerships. And I think we've given them enough room, responsibilities, budget to execute and meet the targets that we set for them. And yeah, we've given them a lot of room to maneuver. We've always built out, we've always scaled the business and built out the business with a lot of good governance practices and guardrails to ensure that we move fast and don't break things. But if we break things, that's not super significant or doesn't have a huge impact on the business. And so we feel very comfortable having our team running with things and building and scaling the business as is, because we know that the business has been structured in a good way. And we measure everything, we track everything, and we, when necessary, jump back in and get involved. But luckily, we haven't had to do that too much because we've had a remarkable team that's done a really good job. It's a super difficult balancing act, and it's so important to focus on both. Well, a good wicket in the existing business, and you continue growing that and maintain that growth rate. And would never want to sacrifice that, but also amazing to have this new software side of the business, supplying software to major partners like a bank. And we have to explore that. Over time, we've started to build out the team on that side of the business so that we can also not be completely, we can still manage both sides without being weighted too much to one or the other.
So you mentioned governance, right? That you've been able to establish and do really well in your business. Can you talk to me a bit more practically what that looks like? Some examples. What do you think's worked really well? Or like anything that you can share with the audience that they could potentially implement in their business?
That's a hard one. This is going to be a hard one to answer without getting into nitty gritty,
Well,
boring
firstly, how do you
details.
define governance? Let's just start there.
Now you're asking me the real questions. How do I define governance? I don't know, having the right controls, systems, processes in place to minimize and mitigate risks in the business and ensure optimal operations. I don't know. You can do a much better job than I can.
I just simply define it as how we go about making decisions.
Yeah.
But everything you said is it says controls, costs, risk, 100%. I mean, maybe it was a bit too broad of a question across the whole business, but you mentioned the fact that the governance has allowed you the ability and freedom to like let your manco kind of run with the core business and kind of take care of the new partnership, new kind of growth opportunities. Like, what did you put in place besides having A players, right? That allowed you the bandwidth to not have to think about this stuff.
So we have invested a lot in tracking everything in the business, and not necessarily to micromanage things, but just to ensure that we are always working and striving towards the right goals, um, and that when we test things, we actually know whether those things work or not. Um, the level of data and insights we have into our business is incredible. We've invested so much into um, data warehouses and pipelines and feeding and transformations and feeding that all into BI dashboards that are live and up on the wall for all of the team members to see, as well as many other dashboards for our executives to monitor performance. Um, and I think that's enabled us. It's given us a lot of comfort to step back, because we know that there's such good data on the business and how it's performing, and it's quite transparent. And we also readily share that data with the rest of the company, so team members know how they're performing, and they know that they're working towards the right sort of goals. It's been super valuable doing that, especially on the sales and marketing side, but not just that. Also on the operational side of the business, back office, and just tracking efficiencies and making sure that with the ultimate goals that we're striving for in the business, are actually being met, and what everyone's doing on a day-to-day basis is working towards that. We've also done a pretty good job. Now I'm going on a slight tangent, but we've done a pretty good job of keeping the entire company sort of mission aligned. We have a weekly town hall where we have all the teams present on the developments and achievements that they've had in the week, as well as the plan moving forward. And we found that that's been really valuable to help different teams understand what each is doing, and it's really encouraged a lot of collaboration across the business. It's also an opportunity for myself and the executive team to talk about some of the high level strategies, as well as important or key initiatives that we're working on, and share updates on those things. And it's so valuable to have the entire company hear those things and see how their day-to-day jobs actually contribute towards that. So we found that that's also been super valuable in keeping everyone mission aligned. Sorry, I went on a bit of a
No, it's fine.
tangent there.
So if I had to summarize it, it's like what's basically allowed you to be able to confidently step back and focus on some of the more complex plays is that you've got a very clear mission and direction for the business, clear set of goals that you've been able to cascade into key metrics according to the department, so everyone knows what they're tracking against and what's important. You've obviously got A players across the business, so you know that they can handle the job and they can be trusted to do so. But everything is really pointed in the same direction. You've got these significant feedback loops. So everything from how is it that we're contributing towards the mission that we're achieving, the rate at which we're achieving these goals, how well we're performing against these efficiencies and these key metrics and KPIs. And with that kind of structure in place, all you need is the right people in the right role, and the business kind of runs itself.
Absolutely. I can go sit on an island.
Well, to be honest, if you wanted to, but you're an entrepreneur and you're never going to stop figuring out ways to grow and problems to solve. But actually, this is where I want to infiltrate my philosophy of what I think success looks like into this conversation. And success looks like is very, very much overlapping with where you're at now. To be honest, it's like you've just given me a new benchmark for how few people you need in order to get there. And what I define success, and this will be full circle back to the conversation around VC, is if you want to exit the business, right, the best position you want to be in order to do so is one where you've essentially got a significant separation between your exco and your manco. So in other words, it's like where you as the founders are only worried about strategic problems. Because that means that anyone acquiring your business means that they're going to just be acquiring your business like your job, right? Because if this business can run operationally without you for a few weeks, if not months, right, and still keep being profitable, selling, meeting these metrics, goals, tracking towards this mission, obviously anything, I think, longer than a quarter, the direction starts becoming a bit bigger, and that's why you need leadership. But for the sake of the arguments, it's like if it can go up to 3 months and you not have to be involved, this is probably one of the most exitable businesses possible, quite literally, because you can step out of it, right? And someone can acquire this moving forward. Now, the other side of this is the fact that you now have the freedom. It's like I view this as the success point as a crossroad, because if you want to exit, you now can at the best multiple possible, because you're going to get an amazing valuation because someone can just take your business and run. Or what you can do is you can free yourself up to give yourself whatever job you want in your company, whether it's executive chairman, head of sales, head of products, and you want to just get back into development, whatever it is that you want to be doing and where you contribute and where you love tinkering, you can have the freedom to do that and let this business keep printing money for you. And the point is, like, now you've got a choice, and the freedom of choice is I can either do this and then the business is not dependent on me, which means I can do what I want with it. I can go after the bank partnership without worrying about the core business. I can go after the geographical expansion. I can start my own bank, do all that, and have this business still keep printing the money, or I can exit it. And either way, is you still need to get, if you still get to that same point, you now have the freedom to choose. And that is how I define what success looks like in entrepreneurship.
It's interesting. It was a few years into the business, I realized that I hadn't taken a holiday in years since starting the company, and I just felt burnt out. It did not feel sustainable, and it was necessary in the earlier stages of the business. I had to be around. I was a critical dependency on so many parts and aspects of the business, so it made sense, and it's definitely served a purpose. But I eventually turned around to my executive team and I said, we need to have a workshop and go through everything that I'm a key dependency on, and then put together a plan to get me removed out of all of those things. This business needs to run without me. And we spent a good 6 to 12 months chipping away at that slowly but surely. Um, to get to the point where now, it is so amazing. I feel like it's like breathe new oxygen into me. I have the freedom of choice, as you highlighted. I have the choice of like what I want to spend my time on, and I have the ability now to focus so much more on these strategic types of partnerships, as well as some other strategic projects within the business. So it's a really fun sort of time in the business for me, because I'm not going anywhere. I mean, I love the company. I think we're building something amazing here, but I love that I'm spending my time on the right things now, and I have more choice over that. After that, I've now tried to focus on my execs and said, okay, guys, where are you a critical dependency in your respective parts of the business? And how do we remove you guys? And so we've slowly been chipping away at that. We've still got a way to go. Still definitely got a way to go there. But it's going pretty well. And I'm super excited about building out that sort of Manco management layer that can run the business and is quite sort of separated from the executives.
I love it. Yeah, because what you're speaking to is basically what the philosophy of my company, MedEvolve, is all about, right? And what we focus on is achieving freedom, right? So I think the point is a lot of us do entrepreneurship in the first place because we care about having autonomy over the problems that we're solving. But then we end up never being able to take a holiday, and then we get to the point of having to burn out before it's like, okay, no, take this stuff off my plates, and then we progress from there. And it's this, and this has got nothing to do with me or the selfishness of entrepreneurship, but the point is, like, that's where true leadership gets unlocked, in my opinion, is because you have that freedom to now go and you develop out your executive team. You like, how do we get you the next level of freedom? And like, when you have someone with such an innovative entrepreneurial spirit, but having with no kind of restrictions in what they need to do within the framework of what their business is, that's when next level growth, next level innovation, next level leadership really happens, right? And so this is what I feel like we're going to make the world a better place, specifically to small businesses. It's really unlocking founders to be free leaders. And that's the change I want to see in the world.
Absolutely. Yeah, couldn't agree more.
So Dan, on the note of being a free leader, that sounds very American. Tell me about the next like 6 to 18 months, man. What does the future look like for you? Kind of post getting this partnership over the line. What's the short-term future look like?
I think we're super excited about growing out this partnerships side of the business. There's a lot of focus there, obviously on this bank partnership, but there are many other opportunities for partners in the space. So super excited there. Definitely a priority in the business. Yeah, as mentioned, there are one or two new products that we're working on in the background, and very excited to get one of those live at least within the next 12 to 18 months. And then lastly, continuing to grow the existing business. There are still improvements there. There's always improvements. We always need to shave that 45 minutes and get it quicker and quicker. So super excited about continuing to work on and innovate just within the existing business as well.
Well, it's an exciting period, man. And I think either way, you have achieved what I deem success to be for many people. So firstly, congratulations for achieving that. And yeah, all the best for the next 6 to 18 months. I hope you continue to just expand the rate at which you're achieving your mission. We want to see more small businesses thrive in South Africa, and you're directly contributing to that. So yeah, thank you for sharing your story, man, and keep doing what you're doing.
Awesome. Thanks, Cam. It's been great.
So Dan and I spoke a little bit offline around how is it that we can structure some thinking. And we spoke about the growth strategy approaches and the categories I mentioned. But the other point that I wanted to mention on is how we prioritize them. I just wanted to share that lesson now. So basically, once we've got all these ideas about how we're going to grow the business, it's kind of useful to kind of categorize them into which ones are, more simple or more complex growth strategies. And then there's the simple test of, is this in alignment with our vision and our mission and direction? And if it's not, it's kind of like scratched off there for now. It's not something to prioritize. But then after that, we bring in SWOT. And our approach is, what am I so excited about that I can't sleep? What am I so concerned about that I can't sleep? Those are opportunities and threats. Then what do I think is holding the business back? And what am I super proud of? What do I think that we're good at? And those are your weaknesses and strengths. The importance of taking this and then comparing them to the growth strategies means that what are opportunities that are actually available in front of us right now? What strengths can we leverage? What weaknesses do we still need to address in the core business that we've been building? And what threats are coming for us? So if we take on more risk, how do we make sure that we're mitigating that? So comparing that to the different growth strategies and ideas makes a lot more sense to be like, actually, you know what, based on where we're at right now, that one, and that one makes the most amount of sense. Otherwise, it's a really intuitive judgment call. And again, there still is, right? I mean, there's a science and art towards strategy in doing this. So yeah, if this is something that you might be interested in, let me know, right? Follow the link in the description of this podcast below. Let's have a chat. We'd love to get your feedback on this test and give you some feedback based on what the test comes out. So yeah, I hope to hear from you soon. Thank you very much for listening to another full episode of the Founder Files, and I'll see you next time. Cheers for now.